Okay, so I think I went through this mostly last Thursday, but I'm gonna go through it just real quick again. So we're talking again about sale of assets, and we have different classifications of assets, and those classifications are dependent upon how the assets are used, not by the character of the specific asset, right? We could have land as a great example. Land could be any number of different types of assets, right? It could be a capital asset, it could be a business asset, it could be an item of inventory as well. So it just depends upon how it is being, how it's being used. So when we talk about ordinary assets, so these are things like sales of inventory, for the most part, sales of inventory and accounts receivable. It's taxed as ordinary income. So just as though you sold an item, so for example, you know, there's really no difference between selling your accounts receivable to another entity or collecting on those accounts receivable. It's still going to result in ordinary income either way, because the accounts receivable is the account receivable. So, but when we sell items in the ordinary course of business, we're going to record that income on our Schedule C, right? But if we are selling those items kind of outside the normal course of business, so I gave you some examples last week about inventory, that if I have a bunch of inventory that I just couldn't sell, so it's not on my you know, if I run a clothing business, it's not on my racks anymore, but I've got somebody who will buy a whole bunch of it from me. I'm selling those items of inventory. That's still going to generate ordinary income, but I'm going to report it differently, okay? I'm going to report it on this Form 4797. Again, so this is outside the normal course of business. And we took a look at this form. We've got several parts to this form, and we're going to go through these different parts as we proceed through the chapter here. So the first part is for most property held more than 1 year. Remember, we've got that distinction between property that was held up to a year and then property that's held more than 1 year. So if it's held more than 1 year, it would be listed in that part 1. Part 2, though, is for ordinary gains and losses. So this is for items that are still going to be subject to ordinary tax rates, items of inventory, accounts receivable, any equipment as well that we've held for less than 1 year are going to go down into this part 2, and these are ordinary gains and losses. These items are going to be taxed. They don't get the benefit of preferential tax rates, okay? So column 1 here is the description. Column 2 is the columns are up here. Date acquired, date sold. So these would all be this, and so this example, we've got a purchase of equipment on April 8th, 2021, sold on March 7th, 2022. That's less than a year. So that's why it's going in this location. If it was held for more than a year, it would be up here. Most property held for more than 1 year. But because it was less than a year, we're going to enter it down here. What we paid for the item, our sale price is column D. The depreciation that we have taken, and it says up here allowed or allowable. That means that even if you didn't take depreciation on it, but you should have taken depreciation on it, you're still going to have to reduce the basis by that depreciation that you should have taken. So you might as well take it and get the tax advantage of it, because otherwise when you sell it, you're still going to get the tax disadvantage of that depreciation. And then the cost, what we paid for it, to then calculate out our gain or loss, okay? So again, ordinary gains and losses are going to go here in part 2 of that Form 4797. And here we're talking about trade or business property, personal property, personal trade or business property that's been held for less than 1 year, inventory, and accounts receivable, okay? So that's what the 4797. So when does the holding period start for an item? When does it, to determine that whether or not it's short-term or long-term, we need to know, well, what's the start date, right? So if it's a stock or a bond, purchased in the securities market, so we're talking about a capital asset in this case. It starts the day after the trading day that you purchased it. So if I bought some Tesla today, my holding period actually starts tomorrow, October 25th. That's when the clock starts ticking, not today. Non-taxable exchanges, the day after the taxpayer acquired the property. Well, the day after the taxpayer acquired the original property. Don't worry too much about the non-taxable exchanges. We really don't do too much on it. If it's a gift, then it starts that the donor's basis is going to be, and start date is going to be our basis and start date. So grandma gives you a house, and she bought it on September 4th, 1972. She gives it to you. Your start date for purposes of calculating these gains and losses will be the same as the date that she purchased it. Okay, and you'll also get her fair market value. So if she paid $3,000 for it, your basis in that property is also $3,000. Doesn't matter if she gifted it to you. If you inherited it, that's a little bit different. Property is considered to be held longer than 1 year, regardless of how long the property was actually held. So grandma bought a house August 1st, and she passed away and you inherited it today. That is considered long-term property to you. You get that benefit of it being long-term. So it's kind of the best of all worlds. Real property purchase the day after the taxpayer received title to the property. If the real property was repossessed, then the date that the taxpayer originally received title to the property. So if it's been taken away, then there's going to be a tax effect to that. But so for the most part, what we're dealing with are these. We're going to talk about the stocks and bonds and the trading day, so the day after that it was actually purchased. Okay, we're going to go on to capital assets next.